There's a theory out there that says the reason Bitcoin isn't worth several $100,000 by now is because it's being manipulated by the banks. You might have seen this on Twitter. People have been revolting against JP Morgan for allegedly shorting a company called MicroStrategy. Now, MicroStrategy is a company whose whole purpose is just to raise money so that it can buy Bitcoin. And at one point, very recently, the price of the stock went down to a level where the value of the whole company was $10 billion less than the value of all of its Bitcoin holdings. That meant by buying MicroStrategy, investors were basically able to buy Bitcoin at a discount. When this story first broke, it seemed like just another conspiracy theory. But after digging deeper, what emerged is one of the most interesting patterns in financial history, something called the debt spiral, and it's a strategy that's been used to destroy empires, collapse countries, and bankrupt hundreds of companies. Today we're going to break down exactly how this works, why it keeps happening throughout history, and whether Bitcoin might be the next victim of this centuries-old playbook. Let's get into it. To understand what might be happening to Bitcoin today, we need to go back in time, way back, to the late 1800s and the Ottoman Empire. Back then, the Ottoman Empire borrowed massive amounts of money from French and British banks. But here's the critical detail. Their debt was denominated in gold, a currency they couldn't just print more of. Then in 1873, the world went through one of the first big global financial crises. European banks stopped lending, interest rates skyrocketed, and suddenly the Ottomans couldn't create new bonds to pay for the old ones. At the same time, their currency was getting weaker, and here's what that looked like to them. Gold prices were going up. But that's not really what was happening. Their currency was just becoming worthless. Gold wasn't becoming more valuable. Their money was becoming less valuable. Eventually, the Ottomans couldn't pay back their debt and they defaulted. But the banks weren't about to just walk away. They forced the Ottomans to create a new institution called the Ottoman Public Debt Administration. This was essentially a foreign group of bankers that took control of the empire's finances. Specifically, they controlled how taxes were collected and ensured those taxes were paid directly back to the creditors. The empire had lost financial sovereignty. Now, this isn't just ancient history. The same pattern happened again much more recently. Greece borrowed hundreds of billions of euros, again, a currency they could not print themselves. So in 2010, when their economy collapsed and their borrowing costs went way up, they couldn't pay it back. The IMF, the International Monetary Fund, forced Greece to create a special fund called the Hellenic Republic Asset Development Fund. Its whole purpose was to take control of the most valuable assets of the country and sell them off so they could pay their debt. Airports, ports, islands, infrastructure, all put up for sale to foreign investors. These are just two examples of the debt spiral happening to countries and empires throughout history. But what's even more interesting is that this exact same mechanism can also happen to companies. And that's where our story really begins. In the early 2000s, regulators discovered something that paralleled what we just described, and it destroyed hundreds of companies. In 2001, the SEC opened investigations into a financing structure called PIPEs, which stands for Private Investments in Public Equity. A portion of these PIPEs were what's called floorless convertibles. This is where things get really dark. These were structured so that the lower the company's stock price went, the more shares the lender got when converting their debt. Let me explain how this played out in reality. First, a struggling company, maybe a tech startup or an internet company, would run out of money. Traditional banks wouldn't lend to them because they were too risky. Then a hedge fund or specialized investment bank would show up with an offer that sounded really helpful. We'll lend you money, but instead of paying us back in cash, you can just give us stock. And if your stock goes down, don't worry, we just get more shares. It adjusts automatically. To a desperate company, that sounds like a lifeline. But this adjustment mechanism, where falling stock prices meant more shares for the lender, created a perverse incentive. The lender could actually profit from the stock price falling. They could short the stock, knowing their bond still guaranteed repayment. The falling price didn't hurt them, it helped them. Here's the spiral in action. The stock price drops. The lender gets more shares. They sell those shares into the market. That pushes the price down even more, which gives them even more shares, which they sell again and on and on. In a study published in 2001, the SEC reviewed hundreds of these cases. What they found was devastating. On average, investors who bought stocks of these companies lost about 34% of their value within 1 year. And this happened during a bull market when stocks were going up. By the end, about 85% of those companies had negative returns after creating this toxic debt. About half of them didn't survive. 48% were delisted from exchanges entirely. The debt spiral had claimed hundreds of victims. So what does this have to do with Bitcoin and MicroStrategy? Well, MicroStrategy has several $1 billion of convertible notes, and while their structure isn't identical to those floorless convertibles, there are some uncomfortable parallels. The risk doesn't come from the conversion itself. It comes from what happens when they run out of cash while the stock is trading below the value of their Bitcoin. That's when people worry MicroStrategy would have to either sell more stock at unfavorable prices or, and this is the nightmare scenario, start selling their Bitcoin. And that would be the beginning of the debt spiral for Bitcoin itself. Alright, let's get nerdy. Because to understand whether this death spiral is actually possible, we need to break down exactly what MicroStrategy looks like today. MicroStrategy is basically a giant Bitcoin fund with a small software company attached to it. In their latest presentation, they showed that they now hold around 445,000 Bitcoin. That's worth roughly $59 billion depending on when you're watching this. That $59 billion pile of Bitcoin cost them about $48 billion to acquire. In other words, they're sitting on an unrealized gain of more than $10 billion. They control roughly 3% of all the Bitcoin that will ever exist. Okay, so those are their assets. Now let's look at their liabilities. They have about $16 billion worth of obligations, debt and preferred shares, against that $59 billion worth of Bitcoin. This is why they love to say their LTV, loan-to-value ratio, is about 11%. Is that good or bad? For context, 40% to 60% loan-to-value is generally considered acceptable in the stock market. So yes, 11% is very low. It sounds extremely conservative. If the story ended here, you'd think there's no way anything could go wrong. They own a mountain of Bitcoin and a small pile of IOUs. But there's a catch. That $16 billion IOU pile has a price. Between the interest on their debt and dividends on all those preferred shares, MicroStrategy now owes about $800 million a year just to keep the machine running. That's over $2 million per day. Now here's something critical to understand. Unlike a normal stock dividend that a company can turn off whenever it wants, preferred stock dividends cannot be stopped. Those preferred investors bought what are essentially Bitcoin-linked bonds with a promise to be paid double-digit dividend yields. That promise can't be broken. So the question becomes, where does MicroStrategy get the cash to pay these dividend investors? The software side of the business is nice, but it's not throwing off $800 million of free cash flow per year. In their latest presentation, they revealed the answer. They created what they call a U.S. reserve, which right now is about $1.4 billion in cash. That cash pile's entire job is just to pay those dividends and interest. And at today's run rate, that gives them about 21 months of coverage, roughly 2 years, without ever having to touch a single Bitcoin. Now here's where things get really interesting. We need to understand something called MNAV conversion. MNAV stands for multiple to net asset value, which is their way of saying whether the stock price is trading at a premium or discount to the value of their Bitcoin. An MNAV of more than 1.0 means their company is worth more than all their Bitcoin. Below 1.0 means their company is worth less than all their Bitcoin. MicroStrategy's entire strategy splits into two different outcomes based on this number. Outcome 1, MNAV above 1.0, the good scenario. When the market is willing to pay a premium for shares of MicroStrategy, worth more than the underlying Bitcoin they represent, they sell stock into that premium. This allows them to raise dollars cheaply and use those dollars to top up the cash reserves, which pay the dividends. This is how they built that $1.4 billion cash buffer. This is the scenario they want. But then there's the other outcome, the one that keeps people up at night. Their own presentation shows what happens if the stock ever trades at a discount to their Bitcoin, when MNAV drops below 1.0. It says, sell Bitcoin derivatives. In other words, the moment the market stops overpaying for their Bitcoin, everything flips. They stop issuing shares because that would be like selling $1 of Bitcoin for 80 cents. Nobody wants to do that. And if the cash reserves run dry, the only way to keep paying those preferred dividend investors is to start selling pieces of the Bitcoin pile itself. This is the structural comparison that people say looks a lot like a modern version of the death spiral. Here's how it would play out. Once the cash pile runs dry, they're forced to sell Bitcoin. Selling Bitcoin pushes the price down. That makes the company worth less. which means they have to sell even more Bitcoin later to fund their obligations. And it cascades, especially when the stock is trading below MNAV, meaning investors aren't willing to pay a premium for the company anymore. That could realistically happen, and it would be very bad for the entire crypto industry and, of course, the price of Bitcoin. How long will MicroStrategy survive if this debt spiral activates? It goes one of two ways. Way 1. Stock trades above Bitcoin value. They can raise cash by selling shares at a premium. That's how they've accumulated so much Bitcoin, and it's why the share price struggles to break through certain levels. Because the moment it does, Michael Saylor rings the cash register and sells more equity. The stock gets diluted and comes back down. Way 2. Stock trades below Bitcoin value. They stop issuing equity because that would mean selling Bitcoin at a discount. Instead, they start burning through the cash pile. At today's burn rate, they have about 21 months before the cash runs out. If that happens and the cash pile does run dry, the only way to keep the machine running is to start selling pieces of the Bitcoin pile itself, and that's what could trigger the debt spiral. That would be catastrophic for the company and devastating for Bitcoin's price. So that brings us full circle back to the original question. What's actually happening here? Why isn't Bitcoin at $200,000 right now? Think about it. We're seeing two opposing forces at play. One force has the incentive to keep this flywheel spinning, because that makes Bitcoin's price go up. The other force has the incentive to keep the price suppressed for as long as possible, which at today's numbers means at least another 21 months. And this is where JP Morgan and the banks become part of the story. The conspiracy version says that big banks are shorting MicroStrategy on purpose, so they can eventually buy Bitcoin cheaper than Michael Saylor did. Here's what we actually know. The truth is, we don't have definitive proof of who's behind this, if anyone. When you look at public filings, research notes, and trading data, at least so far, there's no smoking gun evidence of a coordinated bank attack. But that doesn't mean nothing's happening. JP Morgan has published research that's extremely negative on MicroStrategy and Bitcoin. They've said that if the stock fell far enough and stayed there, it could trigger removal from indexes, costing billions in inflows. They've warned about refinancing risks. You could argue they're creating fear and negative sentiment. But what's missing is the clear link between that and a profit motive. However, there are other players. Jim Chanis's hedge fund has openly shorted MicroStrategy in the past. He's called Michael Saylor a wonderful salesman and not in a complimentary way. There are people who would love to see this blow up just to say, "I told you so," or to buy Bitcoin cheaper. Here's what it probably is. There isn't one coordinated conspiracy. Instead, there are multiple players responding to the same set of incentives. Some people are hedging against Bitcoin, some are betting against Saylor, some are just trading the technicals. But when you put it all together, it feels like a coordinated attack. In reality, it's probably just a lot of different smart money making similar calculations at the same time. All with the same goal, to make money. Whether through shorting, hedging, or positioning to buy cheaper, everyone's playing their own angle. And that collective pressure, that's what's keeping Bitcoin from breaking out to new highs, at least for now. So time will tell how this plays out. Will MicroStrategy's cash reserves hold out long enough for Bitcoin to reach new highs, allowing them to issue more premium shares and refill their coffers? Or will we see the stock trade below the value of its Bitcoin holdings for an extended period, forcing them to burn through cash and eventually sell Bitcoin, triggering the very death spiral that destroyed empires and hundreds of companies throughout history? Personally, I'm still holding my Bitcoin, and if anything, I'm more excited about Bitcoin when there's a lot of negativity around it, because that negativity is fuel. If everyone agreed Bitcoin should be worth $1 million, it would already be worth $1 million. The best opportunities come when there's genuine disagreement and fear in the market. But I'd love to hear your thoughts. Do you think this death spiral will actually trigger? Is this a coordinated attack or just market forces at work? Let me know in the comments below. Thanks for watching. If you found this valuable, hit that like button and subscribe for more deep dives into the world of finance and crypto. See you in the next one.